hello, everyone. We're delighted to welcome you to this webinar, part of our Low Carbon Future series. And today we're excited to share views on the UK government's review of electricity market arrangements, or REMA. REMA could result in, I think it's fair to say, radical changes to the power market in the UK. It's a process that Baringa is staying very close to, not least through our work with National Grid ESO, supporting their assessment of different packages of options. I'm Mark Turner, a partner in Baringa's energy team, and I'm going to be helping to lead today's session. And I'm very pleased to say we have two expert speakers with us today from the Baringa side to guide us through this topic. We have, first of all, Vikash Ahuja. So Vikash leads our GB market advisory team and is a seasoned GB market expert. So Vikash is working across all asset classes, particularly renewables, thermal, storage, and increasingly focusing on market reform and policy and working with clients and the investment community. We also have Tom Baldwin. Tom's GB market expert and currently helping to coordinate our power market modelling and long-term outlook for GB. Tom also has a special interest in biomethane, having worked as an engineer in that sector. So let's perhaps take a look at the agenda for today's session. I'll hand over in a second to Tom, who will take us through the context for this market redesign in GB and talk us through why there's a need for this reform at this point in time. Then we'll talk through the options in a bit more detail. What are the potential packages of reforms that are being considered? And then we'll move on to look at what this means. What would this mean for renewables in particular? What are some of the risks and opportunities that could emerge from these different packages? We will leave some time at the end of the session for Q&A. So we'll run through the presentation and then take Q&A towards the end of the session. Please do use the Teams chat box for Q&A. So please feel free to post questions as we go along. I'll collate those, gather them together, and then we can run through those at the end of the presentation. So I think without further ado, let me hand over to Tom, who will take us through the first part of the presentation.
Hi, everyone. So I take it, though, I mean, you can see this is quite a crammed slide, and I think that's supposed to be symbolism because there's a lot going on in this space. So we've got on the left-hand side a bit of history, bit of market history, privatization in 1989 with NITA, and then integration of the market in 2001, centralisation of the market, and then integration with Scotland in 2005. But really, our timeline starts in 2013 with electricity market reform, 2013, and that introduced the CFDs, contracts for difference, capacity market, and the emissions performance standard, and the carbon price support scheme. And clearly, they have done what they set out to on the energy trilemma. We've had with the CFD significant gigawatts of renewables installed, and that's had and those kind of price support contracts have enabled the cost of capital to come down, improve supply chains, and notably with offshore wind, we've had a 68% reduction in the strike price at the latest auction for offshore wind. Capacity market, we have had security for supply. I know it's quite tight at the moment due to the sort of geopolitical and high gas prices that are ongoing. I think we had a notice this week, and I wouldn't have been surprised if we'd have had one last night, but I think 3 million people in Wales turned off their TVs just after half time, so that helped. And then I think if you look kind of over the past 10 years, ever since the inception of the EMR 2013, there's been a lot of debate around market design. I think we've had a number of proposals, i.e. the supplier obligation from the Systems Catapult. We've had the equivalent firm power auction by Dieter Helm. Lots of debate. It's kind of gone, if people who work in the space will know of it. And then, of course, in that time, we had an 80% decarbonisation target, and now we've got net zero. We've got these new ambitions for a fully decarbonised power system by 2035. And then in parallel, we've obviously had we had the Russia throttling their gas back after the pandemic a little bit, and then they invaded Ukraine, and that's had big implications on gas prices and volatility in power markets. And we've now seen the government announce the electricity generator levy, which is due to come in at the beginning of next year, which is a 45% levy on revenues above £75 a megawatt hour for assets receiving high wholesale market prices, higher than expected. But then this kind of leads us into the point where we are now, where the government closed their REMA consultation in mid-October. I think that REMA clearly is looking at kind of a longer-term structural change to the market, but I do think there is a bit of influence clearly by these recent wholesale prices, and you'll see in some of the options that they've got that there could be a bit of influence there. And I kind of the real key point really is balancing kind of deliverability of change in REMA and the need for investment and investor confidence now and through the 2020s to meet our ambitions. So 40 gigawatts target by 2030. A lot of the investment to make that has to be decided on in the next few years. So radical changes to the market need to be well designed and thought out and protect investors and developers to ensure the cost of capital doesn't go through the roof and costs go higher. I think that takes us pretty well onto the next slide, where we kind of look at the wider sort of challenges of market reform and where we need to address these challenges. So number one, so we've actually taken these 5 pillars from BEIS. They very neatly wrote that out in their document, and we've tried to attach kind of an interesting key point for each of those 5 pillars as to what needs addressing. So on low carbon investment, as I've just touched on, there's revenue risk and uncertainty, especially in the long term, which could slow the pace of investment and raise cost of capital. A key thing from Baringa's analysis is that we estimate that approximately every gigawatt of offshore wind that comes on the system, we see an approximate £1 reduction in the wholesale price. This is not a linear relationship, of course. It changes over time, but this kind of feature is likely to put revenue uncertainty in the long run at risk, and effectively we need some sort of contracts to enable these low carbon investment. And then we have system flexibility. I think it's really important for us to incentivize flex. Electricity demand is set to increase by 100% at least and that's from FES's scenarios through to 2050. So this is going to require greater flexibility, particularly with the onset of increased res, where at times we'll obviously have significant volumes of renewables generating, and that won't necessarily be at the same time as peak demand. So we need a lot of flexibility and signals for that, and we need to facilitate cross kind of vector use of that electricity into sort of green hydrogen, EVs, and then use of that more widely in industry. Demand response is a key part of that as well. And then system cost and locational signals. So I think a really key stat here was that in 2021, 2022, the system operator paid 1.5 billion in balancing actions, and I think this is expected to grow considerably as more and more res comes on the system, particularly where we have a lot of investment in offshore wind at the kind of extremities of the system, but then increased demand at a local level. Making sure we balance this and create signals and mechanisms to enable this is really key as we kind of accelerate towards net zero. And then very similarly, as we have more renewables on the system operability challenges get increasingly harder, particularly as high renewables basically replacing synchronous generators basically means there's lower inertia on the system, likely to see more deviations from the 50 hertz frequency. And we need to kind of create mechanisms to enable the new technologies to kind of replace the old kind of retiring fleet. And then we have managing price volatility. I think in the way the market works at the moment, the market price is set by the marginal generator, and that is still likely to be linked to global gas prices in the long run. We're going to see periods of extremely low prices because of high renewables generation, but then when there's low renewables, we're going to have incredibly peaky prices, which are going to be still set by a kind of globally influenced gas price. And I think like the government yesterday approving Sizewell C kind of reconfirms that they're trying to get away from that. But the reality is that gas is going to be around for a long time in the market. And you can see Germany had a 15-year LNG contract from 2026 with Qatar yesterday that was agreed. I saw on Twitter. So they're obviously betting on gas still playing a big role into the 2040s. So yeah, I think that leads us well on to the next slide where Vikash is going to talk about the options in a bit more detail.
Excellent. Thanks, Tom. You can see that, kind of, if you kind of look at the table at the bottom, this is effectively the full set of options that the BEIS has set out, to kind of explore as part of market reform. So there's quite a wide array of options. Kind of on a thematic level, it is covering various different aspects of power markets. One being the wholesale market, which we're all aware of. Second being mass low carbon power. In essence, that's effectively an investment contract to kind of incentivize investment in renewables. Third being investment in flexibility technologies to kind of respond to some of the system challenges. The fourth one being around capacity adequacy. This is to kind of ensure security of supply kind of in the future. And finally, operability, which is around ensuring stable system operations, managing frequency response, inertia, and other aspects of the power system. The key point I do want to kind of highlight here is from the perspective of renewables, the most relevant are the first two. The first being the wholesale market, in essence, the pricing signal. Obviously, that's a key part of the business case for renewables is around, with the merchant economics. But even when a renewable, kind of generator has a CFD type contract that only covers part of the economic life of the asset, so there's a fundamental value in the merchant tail. So that's probably one key aspect. I think the second key one is around the mass low carbon power, which is effectively the contract in the current market, that is the CFD. And as Tom mentioned, that has been incredibly successful in kind of bringing forward a lot of capacity into the GB power mix. But that level of investment does need to accelerate to achieve zero power emissions kind of by 2035. So that's going to be the second key feature, which will be kind of very relevant for renewables. If you go to the next slide. As you can see, there are lots of options, 32, if you kind of look at each of those individually. These do need to be packaged together because, depending on what you choose, for example, in the wholesale market does have implications for the options in other aspects of the market, like investment contracts and flexibility. So currently work is being undertaken to look at the potential packages which feel reasonable, which are credible, which can achieve REMA objectives. Currently, that work is being undertaken by National Grid in their role as the system operator. Baringa has been supporting National Grid in that. At the same time, obviously, kind of BEIS as kind of the government entity and Ofgem as the regulator are also looking into those packages. There's 6 packages currently being assessed by the ESO, 3 baseline and 3 build packages. When you think of baseline, think of that as a package which is incremental, minimal deviation from existing policies, but enough change to ensure REMA objectives can be met in the future. And the build is effectively an enhancement of the baseline. You're looking at more major reform to the existing policies, but to increase the likelihood of achieving kind of REMA objectives. And the reason there are 3 baseline and 3 build is we're kind of looking at the dimension of a national, a zonal, or a nodal wholesale market. So kind of looking at each of those wholesale markets and saying what other options need to be part of that mix to kind of come for that package. Over the next few slides, we'll be looking at a selection of these packages and having a bit of a discussion around its implications for renewables in particular. Next slide. So this is one illustration. This is a baseline national pricing package. Baseline, again, kind of means minimal deviation from existing policies with kind of a national pricing mechanism. So if you kind of look at the wholesale part of it, it's kind of basically more of the current market design. National pricing continues. There's a single market for flexible and renewable technologies, as is currently the case. It's kind of pay-as-clear pricing based on the kind of marginal generator, and there's kind of self-dispatch in those trading timeframes. Where we're kind of likely to see more change in this possible world is, kind of changes to the CFD with more price exposure to kind of ensure there are reasonable operational incentives, but also reforms to the capacity market to incentivize more flexibility to come online, and there probably also some tweaks on the operability kind of mechanism to make sure sufficient capacity is coming online. And I think in the next slide, we'll just discuss its implications in a bit more detail. So when you look at that package, the baseline national pricing package, the area with the most change is likely to be the investment contract. It would still be a CFD, but kind of modified. And the primary intent being to introduce more price exposure for the renewable generator. And the premise behind that is to encourage more flexible operation of the assets. Obviously, with that change, it creates risk exposure, which will need to be managed. But at the same time, it also does create opportunities for upside with the right kind of risk and opportunity kind of management in place. And probably kind of just a bit more detail on what could this mean. Kind of if you think of the modified CFD, it's uncertain, what that modification is going to look like. But you can think of a few variants which are kind of just important to just bear in mind. Because what happens currently under a CFD is there's an incentive to generate to get your CFD top up, except when you have negative price periods, kind of going forward in those periods, there wouldn't be a top up and therefore there wouldn't be an incentive to generate. Some of the variants you could potentially look at is, for example, around the reference price. Currently, you get a top up based on your hourly market reference price, and therefore that creates an incentive to generate every hour. You could look at a kind of an incremental variant where the reference price is more a weekly market reference price or a different time horizon. And with that, there would still be an incentive to generate, but over a slightly more extended time period. And therefore, there'd be kind of more flexibility potentially coming from the generator. Another variant of this that one could consider is looking at conditions in the market. Currently, negative prices is where there's no top up, but prices which are very low but close to zero, where there's excess renewables on the system, they could potentially be part of the CFD where, for example, you don't get a CFD top up in those hours. The incentive behind that is to ensure there's more efficient operational dispatch. There are more, I would say, kind of more variants to it around a strike price range or locational differentiation that are likely to be considered. So that's kind of potentially where the most change is going to happen on the investment contract. If you look at wholesale price risk, the risk is there, but I think kind of that market, that mechanism is well understood. A lot of us, including kind of people in this call, would understand national pricing reasonably well. The operation of the market is largely kind of unchanged. There's likely to be more locational signals coming through transmission network charging and how that's set. So that's where there's likely to be bigger variation on wholesale pricing. And then the last area is additional revenues. With those changes to the CFD and how flexibility services are procured, what that does mean is there's likely to be better access for renewables to kind of tap into flexibility services. Some of the incentives around, kind of providing flexibility could be there under the modified CFD. So there's potentially an area of kind of value potential in the future. if you then go to the next slide. So in the next slide, you're kind of looking at, you're kind of moving from a baseline national pricing package, which I've discussed, to more major market reform, which could be a zonal pricing package, either a baseline zonal pricing package or a build zonal pricing package. But in either of those, there's quite a significant change around the zonal pricing aspect, which is very different from national pricing. If you kind of look at a few other key aspects, it's still going to be a single market for renewables and flexibility. From a balancing perspective, I don't think the market changes a lot, but there could be a greater role for DNOs to play in it, more local balancing before it comes to national grid as a system operator. From a price formation perspective, same as before, kind of marginal pay as clear pricing. In terms of dispatch, there's optionality. Self-dispatch is the current way to do things. In that world, there could be more centralized dispatch where the system operator has earlier visibility of the positions of kind of different trading counterparties, is able to kind of basically act in that market earlier, to kind of resolve some of the system actions. And then on the mass low carbon power, you could potentially be in a world with modified CFD with a bit more price exposure, but there could be more radical change if you were to look at an alternative revenue cap and floor type mechanism, which has been used for interconnectors quite effectively to date, but is a mechanism which could be considered for renewables in the future. And what that mechanism broadly does is it allows a minimum level of kind of guaranteed revenues, i.e. the floor, which enables kind of those projects to get financed. But then there's a kind of a window between a cap and floor where the generator basically has an incentive to operate across different markets, whatever it kind of deems kind of suitable. On the flexibility and capacity adequacy, quite a few variants around the CM and its kind of potential change, which could be part of the mix. And on operability, you could be looking at more kind of local procurement at the distribution level first before you kind of have more national procurement. If you move to the next slide, that's where we'll cover some of the key implications in this world for renewables. I think the 2 points to highlight: one is the investment contract. That was a key area of change, even in the baseline national pricing package. In this world, there's potentially likely to be more change in that investment contract. It might be a greater deviation from an existing CFD. It might be a replacement of a CFD with a kind of a revenue cap and floor to encourage kind of participation of renewables in different markets. And I think that presents both an opportunity and a risk. The commercial structures to manage risks, to explore the upsides in this world would need to be evolved and developed. So I think that's quite an important dimension to consider. I think the other key change in this world is going to be around wholesale pricing risk, because you've moved away from a national pricing to a zonal pricing mechanism. So there's a locational signal. There's likely to be significant divergence in zonal pricing. There are going to be aspects where some zones which are generation dominated, potentially with lower pricing, demand dominated zones, on the other hand, potentially with higher pricing. So yeah, and that's going to evolve over time. And part of that is going to be, if you think about the GB national price, transmission investment isn't a key driver of a GB national price because transmission constraints are not being taken into account. In this world, with zonal pricing, they are going to be a key driver. The level of transmission investment at kind of various key boundaries is going to determine the shape of kind of future pricing levels. And what that does mean is location becomes critical. How, as a renewable generator, you think about the value of siting in an appropriate location, given where the market currently, then how it may change in the future is going to become more important. I think just one other key aspect to highlight here is, now in this world, there's a lot of change, but that change is likely to come with some mechanisms around kind of transmission rights to help generators kind of mitigate that exposure. So it's not just there's a level of change and tough luck generators, from a market design perspective, one does need to think about, transmission routes, how those are structured. Is there going to be grandfathering of them to help manage some of that exposure? And I think the last point is on additional revenues. I think in this world, more change, more participation, there's greater value potential. But obviously, as a renewable generator, as a portfolio player, you'd have to evolve your kind of business model, trading capabilities to be able to capitalize on that value. So I'll probably at this point kind of hand over back to Tom.
Hi, it's just checking my Wi-Fi. Sounds a bit.
Seems okay.
Okay, seems okay. All right. So I think we're just here. We want to kind of illustrate a bit of the work we've been doing on modeling, kind of trying to do an illustration or a model of a zonal market. So as Vikash has said, it is under consideration to move towards locational pricing, and when I think that started hotting up kind of earlier in this year, after the ESO's nodal pricing review, then we kind of developed our modeling capability to try and produce a zonal model and look at what this means for different asset classes in the market. So we've divided the GB up into 8 zones. As you can see, we've derived this from the electricity 10-year statement, basically looking at where the most constrained regions are. And just to sort of pull out a couple of features, I guess, of these zones. So in the north, lots of wind generation, less demand. In the south, especially in the SC1 border, lots of interconnection, so high demand and kind of convergence of pricing with Europe. In East Anglia, lots of offshore wind, and then in X and SC1, lots of solar, and kind of in X, very high demand. I think if we go to the next slide, we want to try and zoom in on a couple of divergent zones and really kind of bring out what this means for different assets, renewable assets. So yeah, so the 2 zones we've used to illustrate this divergence is the B4 zone in Scotland and X, which has London. As you can see, we have the capacity mix, the evolution of the capacity mix to 2030 and peak demand. So in Scotland, you can see half of the capacity mix is made up of onshore wind, and in Zone X, you can see that you've got a much more diverse mix with more solar, lots of gas generation, CCGTs, OCGTs, and quite high peak demand. And if you look in 2029, so on the next slide, we're going to look at a spot year of 2028, and that's just before in 2029 we've got this kind of onset of pump storage in B4. So we're kind of looking at it before this additional flexibility has been added into the B4 zone. So going onto the next slide. That come up. Yeah, so I think on the top, what you can see is the relative delta from a sort of national wholesale shadow price in both zones. So for B4, you can see in January, February, March, and then October, November, December, you can see quite significantly lower wholesale prices in B4, and that's because it's a very wind-linked market. And then in X, you can see as there's a very high demand region, we're getting quite high prices in those sort of winter months. So and interestingly, we picked this because they're quite mirrored in that regard, kind of having an opposite effect, showing kind of maximum divergence that we see across GB. And then to really bring that out on the bottom, we've got on the left, we've got the B4 zone, and we're looking at wind generation, onshore wind. And what we see is you can see the profile is in green, the wind profile, and you can see how correlated the capture price discounts are in that zone to the offshore, to the wind profile. So every time the solid pink line is above the dashed pink line, we're saying that your capture price is lower in a zonal market versus a nodal market. And you can see that's heavily correlated to the wind profile. So it's basically having a significant impact on your wholesale capture price if you move to a zonal market. It'd be for wind generators, and kind of every time that's above the dashed line, you're kind of representing you're offering less value to the system as an onshore wind farm in that zone, and that obviously means there's less signals for investment. zone for wind generation, but there could be signal for other stuff like flexibility, pump storage, hydro, batteries. And then on the right hand side, I think the picture is a bit more mixed. So you're actually seeing in sort of January, February, and in December a little bit, you're actually getting a slight premium versus what a national price would get in that zone, in that area. So that's showing that your solar is offering greater service to the system, and that's because the demand is very high, so the prices get very high in that period. And then in the summer, obviously, it's kind of clear is that when there's a lot of solar generation in the summer, you're going to be increasingly cannibalized in those months, and that's why the kind of dashed line is below in this chart. I think it kind of is quite a good representation of the different zones and how divergent they would be for different asset classes across GB. I think if there's anything to add, Vikash, I think that's.
I think that covers it well in terms of the potential range of outcomes. I think something to be aware of, this is a kind of snapshot of a point in time. There will be an evolution, and as I've kind of mentioned before, the level of transmission investment and the pace of that is going to ultimately determine the level of differentials being kind of lower or wider in a world with kind of a zonal or nodal pricing is going to be key. Excellent. Should we move to the next slide? So just kind of bringing this all together, I think what's clear is with REMA, there's likely to be change, but there's going to be a spectrum in terms of it could be minimal change to more radical change. That's basically kind of live debates and discussions kind of happening on that front. So kind of in that world, kind of what that means is across these key dimensions is probably kind of worth kind of bringing out a few key areas in terms of the level of impact. If you take kind of wholesale pricing risk in a national pricing world, I think the risk is there. You know, even in a national pricing world, there is significant uncertainty on where price levels may end in the future, how much capacity will come online through investment contracts, how much demand side response will be there. But I think it's reasonable to say that that risk is there, but it's reasonably well understood, recognizing the uncertainty around that. If you move to a more locational pricing world, be that zonal or nodal, that there is going to be more kind of material kind of price risk, locational divergence, and it will create kind of winners and losers on its own. But that is going to be mitigated by, you know, kind of transmission rights, be that physical or financial, to kind of help kind of mitigate some of those kind of creation of winners and losers simply because of a change in market design, particularly for existing market participants who have their business case being premised on firm access to the transmission network. For some of the newer capacity coming in, it might be a different conversation where these mechanisms would still be there, but how they get allocated might be through more kind of competitive means. So there's a kind of much greater risk with locational pricing. On the investment contract, I think there's the kind of two aspects. One is the availability of the investment contract, and the reason we bring that out is there was a time kind of a few years ago where offshore wind was a key player in CFD allocation rounds, but onshore wind and solar, they were part of the first allocation round, but not part of the next few, because the argument was those are mature, established technologies, which can kind of basically be built on a merchant or a corporate PPA basis. I think our kind of read of REMA is that given the pace of investment needed in renewables by 2035, there's likely to be greater availability of an investment contract for offshore, onshore, and solar. I think that there's a clear signal from the government that probably the volume of investment contract is going to be increasing, and therefore in that kind of what that means is there is a significant market opportunity the size of the market is going to grow, the investment is going to be there. There's going to be some underpinned by an investment contract. So I think the opportunity is there. But what's going to change is the form of that contract from a CFD to a modified CFD or some alternative mechanism. And what that does introduce then is greater price exposure. There's a spectrum in terms of the level of change. And there's going to be kind of more merchant risk and opportunity that as a renewable generator that you need to be aware of and kind of gear up for. On additional revenues, I would generally say where this is going is introducing more flexibility, creating more incentives to provide that flexibility, and also opening up those markets for renewables around operability and capacity adequacy and flexibility. So I think there's an opportunity there. There'll be more access, there'll be better incentives. Obviously, capabilities will need to be developed to kind of monetize that value in those markets. And finally, kind of on route to market, this is not something we've kind of touched in the previous slide, but it's a key part of the business case in terms of a renewable generator having a route to market and off-taker being there to help kind of sell power in the market and monetize value. I think it's reasonable to say that space is going to change, even in a world with minimal changes. The element of greater price exposure does mean that you'll have to work closely with the off-taker on kind of more active risk management, kind of to mitigate the risk, create upside opportunities, which may lead to some extent kind of higher route to market costs. And in a world with more major market reform, given the nature of the arrangement is going to change quite radically, there's likely to be kind of greater scope for increase in route to market costs. So I think that kind of summarizes, kind of in terms of the key risks around the various different aspects and potentially the materiality of that.
Fabulous. Thanks so much, Vikash. Thanks, Tom. Really, really interesting summary, and I think plenty of topics to get stuck into there through the Q&A. So please do add your questions into the chat box. We've had a few there already, which we'll work through in a second. I think one immediate question from my side, Tom, Vikash, is just what are we expecting next on the process? Can you maybe give us a view of what the next steps might be on the consultation? When do we expect to hear back from government on that?
I'm happy to give that a quick go, Vikash. So I think obviously the consultation closed responses in mid-October. So BEIS will obviously be evaluating them, and I'm sure there's many hundreds of them, and they're very complicated. So it might take a little bit of time for them to do that. And I'm not going to expect anything before Christmas, especially with them working on the electricity generator levy. But I'd expect them to signal some kind of direction of travel in the first half of next year, or at least a review of the kind of responses and a summary and a kind of directional hints at where they'll be going. And then potentially another consultation middle of next year. And then in parallel, I guess we've got continuing CFD auctions. We've got AR5, AR6, which are already kind of booked in through to 2024. So any kind of small changes to the CFD, you couldn't really expect that until AR7 at the earliest. Even that could be slightly ambitious with the kind of timelines. And then on a kind of bigger, more grander deviation, you'd expect BEIS would have to consult on that, design that. So say for zonal or nodal pricing, could take a couple of years to kind of design and consult on that. And then in parallel, there'd be a lot of work that would have to be done at the ESO and Ofgem level in the design and implementation of that. And any kind of zonal or nodal pricing, you'd be looking at we've looked at other markets that have kind of implemented this, and it does take a few years. So maybe 2027, 28 as at the very earliest to kind of see that change in the market. If you
just a couple of builds on that. One, and the timing is obviously kind of BEIS is doing that process, but let's be aware of the work that ESO is doing around the packages, as I mentioned, which is part of their net zero kind of market reform process. They're kind of currently in that phase 4. And I think intent there is, kind of Baringa has been supporting that is, I think the next steps on that are kind of, further work done by Baringa to support ESO, and then ESO early in the new year takes a kind of a rounded view on kind of their view of packages. So I think there will be a degree of interaction early next year between, the ESO's views of kind of potential packages and how that kind of overlay some of the feedback that they've received, BEIS has received on the consultation response. So will be quite an active space Q1 next year. I think the second build is just a small build on kind of Tom's point and the next allocation. I think what's quite clear is the CFD itself is probably not going to change for allocation the next couple of allocation rounds. Obviously, there might be changes to the budget and the parameters to accelerate investment in renewables. So that's a key dimension to keep in mind. And we'll probably hear more on that later in December in terms of budget. But I guess the second key aspect of this is even bidding into the next allocation round, and the CFD period doesn't change that much because it's the same, but that's only 15 years of a longer economic life. So I think as a renewable generator, when you're bidding into that auction, fundamentally, you do need to take a view on the risk and opportunity of market reform change and what does that mean for the post-CFD value. So I think that's another key dimension to kind of keep in mind, even bidding into the next couple of allocation rounds.
Brilliant. Thanks, Vikash. Thanks, Tom. I'm going to attempt to sort of group questions here sort of thematically. And I wonder whether we maybe start off with a couple of questions around sort of price setting under the potential new arrangements and also competition as well. So we had a question in which was around, I guess, issues going back with the old pool system and drivers for that being replaced, including a perception that there were a few plants acting as price setters in the market. And so there wasn't a huge amount of variety around that price setting. The question around whether there's a risk of kind of moving full circle back to that situation where we have a few gas-fired assets driving the price in those cold, low wind periods. Maybe views on that, Vikash, Tom?
I think that's a great question. Maybe I'll kind of start and Tom, you can come in. I think that's a really important point. Kind of as you move from a national to a zonal, and then even kind of going further in the nodal pricing mechanism, particularly around nodal pricing, kind of the element of market power becomes kind of more material to consider. But as part of that, I think part of this kind of the answer is going to be assessing implications, not just in terms of kind of value for different asset classes, but what does this reform mean for impact on liquidity in the market, appropriate kind of mitigations in place to kind of mitigate kind of market power. I think, again, there are going to be debates around evidence, but I think some of the evidence from nodal pricing in established markets like the US and Canada, measures are put in place to kind of mitigate some of those kind of market power concerns, potentially through a kind of a more standardized scarcity adder, etc. So I think you're absolutely right that that concern could be there, kind of coming full circle, but part of the answer needs to be kind of active mitigation of that.
Yeah, I guess certainly be a very different kind of technology mix and probably more diversity, more variety there in the sort of REMA system than we would have had in the pool. So with storage, with demand side response, interconnectors. So one would hope there was more competition and diversity around the price setting. But yeah, really good question. I think then so related point around the price setting, the different markets. There's a question around, I think comment you made, Vikash, around maybe no real change to the balancing market, and whether zonal pricing wouldn't sort of replace, in effect, a lot of Scottish curtailment of renewables, and whether that has the potential to reduce revenues for sites in Scotland. I guess in a zonal market, do we potentially sort of swap physical curtailment, which is happening through dispatch down through the balancing market with market curtailment, because you're not clearing within your zonal sort of node. But yeah, views on that.
I think the slide, I guess the slide that I presented, I think, as or just slightly after that question was asked, clearly shows that is the exact effect that is happening. So instead of the balancing mechanism kind of having to make great payments at the cost of consumers and to the ESO, if effectively you're basically just cannibalizing revenues in that zone to a greater degree, which obviously is like a signal that the investment in wind in that zone is providing less and less value to the system, as you're basically just competing against other wind farms rather than being kind of balanced in the BM.
I think a slide built on that is the time dimension of it, right? So at a point in time, I think that's right, kind of more economic curtailment. But what that does is kind of creates that price signal for investment response, for storage, kind of looking at business models around storage, electrolyzers, demand side response, which are then going to be, kind of basically the signal to kind of, invest more in that capacity in that region. So I think that's likely to lead to more investment response in those technologies to help mitigate some of that, possibly kind of create more innovative business models to be structured around that.
Brilliant. Brilliant. We've had then a couple of questions on the impact on investment in the market. So maybe a couple of related ones to start with on that. First, we had a question on generally, what's our view on what the proposals do around investment? So particularly for the modified CFD, do we expect that to support the delivery of government targets around renewable build? And then maybe a sort of closely related point, have we taken a view at this stage on the cost of capital impact of some of these changes? So kind of move towards locational marginal pricing and some of the changes proposed on the CFD contract side. So yeah, kind of views on that investment angle, maybe.
Yeah, I think it's a great question and a really kind of tough one. I think in terms of change, whether that's kind of minimal, incremental, or more major, there's still kind of some change, right? And that does create uncertainty around how do I deal with that change? Does it create more value or does it create more risk? So generally, kind of in our conversations with kind of different market participants, there's a general concern around the level of kind of basically change coming. And I think that's ultimately one of the key trade-offs that does need to be kind of managed and mitigated from a policy perspective, is ultimately that we only have 13 years to meet that 2035 target. We still want to change the system to make it more operationally efficient, still maintain the signal. So I think that's going to be one of the key decision kind of complexity around kind of decision making there. But I think what's clear though is that that investment contract being there is a clear signal, at least in terms of the size of that market growing, clear intent from government to provide that support. And I think that could be quite bankable, given it's going to be underpinned by the government. But at an operational level, it does create that additional kind of risk, but also opportunity depending on, kind of your location and siting decision. So I think those are the two dimensions that the government will be considering here. Tom, any builds on that?
Yeah, I agree. I guess ultimately, I mean, the reason we showed that sort of 2028 view for zonal in our modelling, we haven't optimized for capacity, as Vikash said, so we haven't added the kind of WACC implications of that. But ultimately, if you're an investor in an offshore wind farm and you've got a 15-year contract or a CFD, and then at the end of the CFD you're in a zone with lots of other offshore wind farms connected to it, then in that zone there is going to be more market cannibalization. for your product, and that's going to have an impact on the WACC, because obviously you assume level of merchant returns, and that's what we're showing you there, is that ultimately that would decrease. Well, it would decrease those returns as kind of we transfer kind of rent towards kind of consumers for lower prices.
Brilliant, brilliant. A couple of sort of comments around the impact on end consumers and on customer bills and the costs of this. So I think the first question was around the potential upside for generators and renewables under future CFDs, that being an intriguing prospect. Question, is that politically acceptable in the current climate? I guess ultimately it's how that's paired with the downside risk. So if the generator's taking on more risk, it's getting upside maybe as a compensation for that. I guess what we have seen is that CFDs have been a very useful and effective hedge for end consumers in the current climate. And I think certainly governments really appreciated that, not just the UK government, but elsewhere in Europe as well. And those difference payments are really helping with customer bills. So I think maybe a quick sort of comment on that, and also just views on how can zonal or nodal pricing be implemented in a way that's fair to end consumers who are obviously tied locationally. Will consumers face potentially higher bills based on where they live? Is that something that's being considered? And yeah, is that a risk in the proposals?
Let me cover the first one on the kind of the generator kind of return, and Tom, maybe you can cover the one on consumers. That's a really interesting point. I guess if you kind of look at all the options under consideration, they kind of sort of moving away from a fixed output-based compensation to, even if it's output-based compensation, with a range. So kind of basically a cap and a floor, or a kind of a strike price range. What that does mean is there's still a hedge, but with the kind of with the range around it. So there's a cap there, which does kind of feed into that price hedge, i.e., kind of it still would likely remove the ability of kind of massive inframarginal rents as we are seeing in the current environment, because there would be a cap element to it. Now, what you don't want is, kind of perverse incentives where there's no incentive to generate in very tight periods. So there's an element of how you design the cap, and an element of risk and opportunity sharing needs to be considered. But I think whether that's a CFD strike price range or a revenue cap and floor, there's an element of a cap there, which basically I think does remove the possibility of massive inframarginal. There might still be some sharing of it, which I think is reasonable. But I think, I think it does kind of cover that point around that kind of massive exposure to prices for consumers. Tom, do you want to cover the point on consumer bills?
Yeah, I mean, I guess, yeah, I think when we project the kind of CFD build out, I think by 2030 we have about 35% of demand kind of hedged for GB consumers, and I think if we're going to meet net zero, a lot of this is going to be built from contracts, and I think that's obviously going to go probably higher than that 35%, and I think it's probably also not really palatable for politicians to have very, very diverse prices in different regions. People are living in a certain area and they're going to face higher costs. I don't think it's I think there'd be some sort of protection for consumers, maybe kind of national sort of shadow price for any kind of contracts, which would ultimately make people not be less well off because of what region they're in. But the signals will still be there in the market for kind of for suppliers and demand, big consumers of demand.
And I think we've seen that approach in a number of nodal markets, is the residential consumer potentially is less exposed to the variation in prices, because there are fundamental questions around equity and distribution. But on the larger kind of industrial and commercial consumers, can either self-opt or over a kind of a phase period be more exposed to that pricing signal, because part of this is, you know, kind of moving away from a supply setting a price to demand playing a much more active role in terms of where they locate, the response signal that they provide, and I think industrial and commercial are probably, at least in the first phase, better kind of, you know, kind of able to kind of do that in the first instance, and over time that can be opened up to residential consumers.
Brilliant. I'm going to hold back the temptation to carry on with questions. There are actually quite a few very, very interesting questions we could get onto, but I'll get into trouble and we'll time out. So I think let's leave it there for this session. Can I just say thanks so much to everyone for attending and for contributing, I think, some fantastic questions on this really interesting topic. Thanks so much to our speakers. So thanks, Vikash, thanks, Tom. Really nice summary of the situation. Can I just draw your attention to the next couple of webinars coming up in our Low Carbon Future series? We've got two really, really interesting sessions coming up this side of Christmas. So next week, talking about European gas, security of supply and the latest situation on that. That should be a really interesting session. Please do put that in the diary. And then I think the following week, we've got related theme session on impact of Ukraine invasion and what's next out to 2030 as a result of that. So please do come along to those. You're most welcome to attend. And although we've timed out on this session on the Q&A, please do reach out if you want to continue the conversation around REMA, or if you need assistance or you want to talk to the team, please reach out to Vikash, to Tom, or myself. Thanks very much then, everyone, and goodbye. Thanks for joining.
Thank you.
Thank you.